Welcome to an introduction to accounting, brought to you by Parkbench Tutors. Parkbench Tutors, you can find us on Facebook or look us up on the internet. In this short podcast we're going to continue our work on cost accounting and look at the cost of inventory by a method called FIFO. So, what do we mean by inventory? Well, inventory, or stock if you're a little old-fashioned, means the raw materials or the work in progress or the finished goods that you have and that you're waiting to sell. So how much is the inventory worth? If we pay different prices for materials at different times, what effects is this going to have? And which price of materials should we use when we're trying to calculate the value of our inventory? It also affects financial accounting because inventory is an item on the statement of financial position. Over time, at least 5 different methods have been used to determine the cost of materials. These are FIFO, LIFO, AVCO, which is a simple average, or AVCO is a weighted average, or standard cost. You should note that LIFO is no longer in use in the UK, but you will still find it used in the USA. FIFO then stands for first in, first out. It assumes that the oldest inventory is being sold first. That also means, of course, that the inventory that is left will be the most recent. Now, it's important to note that this is for determining costs. It's not what may actually happen in a store. If you go in and buy a microwave, it doesn't mean that the sales assistant is going to go rummaging around in the warehouse to find the oldest one that he's actually got in stock. So, how does FIFO work? Let's consider an order for Stella chips, a new item of inventory. The reorder quantity has been set at 50, and therefore to purchase we need to set out a purchase order for 50 of these chips. When the chips are received, they have a unit price, so if you multiply that unit price by 50, that is the value of your inventory at that point, 6449.50. Now let's assume that we issue 10 chips. The inventory that's now left, or which is available, is 40. So if we want to do the value of the inventory at that point, it's 40 times the 128.99 that each chip is worth. So it's 515,960. Now, supposing there is an increase in demand for the chips, and we need to purchase another 100, and this time we pay £115 per chip. And then 3 days later we issue 60 more chips for production. At each point there's a FIFO value for the inventory. So on the 20th of September, when we've ordered 100 and just received 100, we have 140 in inventory, of which 100 were at a unit price of 115 and 40 were at a unit price of 128.99, making a total FIFO value of 21,259. Right? I calculated this, remember, by saying that 40 of those chips were purchased for £128.99 and 100 were purchased at £115. That's how I got my cost of inventory. Now, when 60 chips are issued, that only leaves 80 in inventory. And we work out that the 80 chips are worth 9,200. How did I get that figure? Well, FIFO comes into play. We had 140 chips in inventory, and there were 40 purchased at the older price and 100 at the more recent price. So, when the chips are issued, we assume that the 60 chips that are issued are the 40 at the old price and 20 at the new price, which leaves us just the 80 chips at the new price. So the cost of inventory is 115 times 80, which is the 9,200 that we came to. The accounting software will often do much of this work for you, and they're usually giving you an offer of choosing how you cost inventory, or they are set to FIFO. In fact, most common programs are set to FIFO as the default. So if you use something like AdminSoft Accounts, FIFO is set as the default for inventory there. And if you look up in the help section, it will tell you that all the lists are produced on the basis of first in, first out, so it's used to work out the actual cost. And if you use something like Sage Line 50, you also find that this also defaults to FIFO for costing purposes. So, does it make a difference if prices are rising or falling? Well, let's consider buying some Astro widgets. We purchase 5,000 at €4 each, and then use 2,900, then purchase another 6,000 at €6, and then use 4,100. Okay, so we have to calculate, say, the inventory cost at the end of the June 10th. Now, supposing the June 6th purchase had been €3 each, what would the inventory cost then have been on June the 10th? Well, actually, it's fairly simple, because we only need to consider the number of Astro widgets in inventory at the closing date. So if we purchased a total of 11,000 and used 7,000, that means we've got 4,000 left. So if we had 4,000 at €6, that would mean our inventory value is €24,000, whereas if we'd been purchasing them at €3, then the inventory would have only been at €12,000. So why are we interested in these calculations? Well, because the value of the inventory appears on the statement of financial position, and of course the value of the inventory also will be reflected when we calculate cost of goods sold for the income statement. FIFO then is the most common method of costing inventory in use in the UK, and as I say, most accounting software uses it. Obviously, with accounting software, the advantage then is if you've got something like 50 different products that you are selling and trying to calculate all those values for FIFO for each individual product, it takes some considerable time. So accounting software is set to do a lot of that work for you. It doesn't mean, by the way, that if you're tracking the inventory using accounting software, you should ignore the fact that you still need physical checks on inventory, checking for losses, for damage, theft, or for any other reason. That ends our first short podcast on FIFO, brought to you by Parkbench Tutors and narrated by David Hopcroft. Thank you for watching and for listening. We wish you success in your studies. For more information about Parkbench Tutors, look us up on Facebook or on the internet, parkbenchtutors.com.